Okay, so in this video, we will be discussing RA 10607, which is essentially the latest insurance code of the Philippines. Okay, so this was passed in 2012, but I think the full implementation of it, the IRR, and essentially the insurance companies being able to follow the provisions of the law, it all happened sometime in 2013. Okay, so this document is 98 pages long, but for this video, we'll only be discussing up to page 12, which includes the general provisions of the law, and then the latter part, I think we'll do a second video for the different types of insurance. That was on page 13 onwards, and then the latter part, I don't think we would be discussing them. So we have the, what do you call this? Organization of insurance companies, the minimum capital requirements, and then other requirements for them to be able to secure a license or approval from the insurance commission and the BSP before they get to operate as an insurance company. And then of course there are also provisions on the company, the insurance commission, the monitoring, supervision, the powers that the regulatory authorities have over them, and then essentially there are a lot of miscellaneous provisions, but more on the regulation side of things, and as well as the guidelines on how they should operate. Some things about claims, fraud, and then premiums, payment of premiums, effectivity of a policy, the policy statements, the contents of that, and then essentially how they're going to offer the services, and then make sure that claims against the insurance policies are there are provisions that are provided, and those should be followed, are implemented by the insurance company, so to avoid problems, to avoid complaints, things like that. All right, and so let us begin. RA number 10607, an act strengthening the insurance industry, further amending these are the old laws that are they call this covering insurance companies, right? So we have PD number 612, insurance code, and then we have the presidential decree numbers 1141, 1280, 1455, 1460, 1814, and 1981. So there are a lot of presidential decrees that have been made, and there are a lot of amendments that have happened covering the insurance industry, right? And there's also Batas Pambansa 874, and for other purposes. So section 1 hereby further amended to read as follows. General provisions. This decree shall be known as the insurance code. So we have the latest provisions. Whenever used in this code, the following terms shall have the respective meanings hereinafter set forth or indicated, unless the context otherwise requires. Okay, so essentially the terminologies or definition of terms. A contract of insurance is an agreement whereby one undertakes for consideration to indemnify another against loss, damage, or liability arising from an unknown or contingent event. Okay, so that's essentially insurance. So for example, life insurance, right? A person who applies for life insurance is essentially what is asking is that if I die, would you please provide financial assistance or a lump sum of money to my family, so that they would not be burdened since I'm supporting them. So in the case, one person's death it's a contingent event, it's unknown when it's going to happen, and there would be a loss or damage or liability that would arise from someone's death, especially if he's supporting other people. So the loss, damage, or liability there is that in case that person dies and he's unable to support his family or loved ones, then the insurance company would make sure that the family members would get something to support them financially as they, in a way, cope with the loss of the person, right? So essentially, in exchange to that, the person would then pay insurance premium, right? So there would be a lot of period. So for example, during the first 5 years or 10 years, the person is still alive. So the company, the insurance company would not indemnify the person because the contingent event hasn't happened yet. Okay, you're still alive. Okay, the contract of insurance for the life insurance is that only if you die would we provide financial claim to your family or something, right? And so during the period of time that the contingent event did not happen, so it's some sort of profit or earning on the side of the insurance company, right? Especially if the person is very healthy and very blessed, and so he's able to live for a long period of time, let's say 50, 60, 70, right? And so in that case, the insurance company would have benefited from the contract of insurance, right? But if the person dies for, let's say, after 5 years or after 10 years, so he only paid 10 years worth of premium, and yet the insurance company would indemnify his family members for a certain amount of money. Sometimes it's in the hundreds of thousands. Okay, so let's say let's say 500,000 or almost 1 million pesos would be the value of the claim. Okay, but then the annual premium, let's say the annual premium is only 2,000 or 3,000 pesos. So for 10 years, that's only around 30,000 or something. But the family, in the event that this person dies, would receive 500,000 or nearly 1 million. So again, those things would also depend on certain computations, of course, by the insurance company. Of course, the higher your premium is, the higher is the value of the claim or the benefit that would be provided to the beneficiary in case the uncertain event dies or the contingent event the contingent event occurs or the condition happens, right? Okay, so that is basically it. Of course, normally, if you pay lower premiums, then the benefit is also low compared to if you pay higher premiums, then the benefit would also be higher, right? So there's that relationship between premium and benefit. Okay, a contract of suretyship shall be deemed to be an insurance contract within the meaning of this code only if made by a surety who or which as such is doing an insurance business as hereinafter provided. Okay, so if you've forgotten what suretyship is, so for example, there is a contract between two people, right? For example, a contract to build, let's say, a 5-story building. Okay, so there's a contract, let's say, contract to build. Okay, and then this person is paying the contractor, let's say 5 million for every floor or 10 million for every floor. But then suddenly halfway after building only 2 floors of the building, this contractor disappears or had some problems, run away with the money, and basically did not complete building the structure, right? So if that contract is insured through a suretyship, so in a way, the person would be able to get a claim from the insurance company through the contract of suretyship a certain amount of indemnification, because this person ran away, did not complete the contract, did not complete building the structure. So have to, if there's the loss or there's the damage because the building needs to be completed but it hasn't been completed, instead of being able to use that for business, it hasn't been used yet because it's not yet finished. And then of course, if there's a possibility of financial fraud, the person ran away with the last payment, did not use it to build the structure, so that's also going to be a problem. That's a contingent event. Okay, so it's normally for a contract of suretyship, it's the person, for example, the person paying the the contractor to build the structure, right? Normally, it's the contractor who pays for the premium of the contract of suretyship because he's the person of interest, because he's the one with the obligation to build the structure. And in case he is unable, or for some reason he did not complete the building of, or the completion, he did not complete building the structure, then the suretyship would indemnify or pay for the damages to the party aggrieved by such situation, right? So that's for suretyship. Okay, and that's just an example. Of course, there are other types of or situations that would also apply for that. Okay, the term doing an insurance business or transacting an insurance business within the meaning of this code shall include making or proposing to make as the insurer any insurance contracts. The insurer pertains to the insurance company, right, or the agent of the insurance company. Making or proposing to make as surety any contract of suretyship as a vacation and not as merely incidental to any other legitimate business or activity of the surety. Okay, so this time it's some sort of surety contract. The first one is insurance contract. Thirdly, doing any kind of business, including a reinsurance business, although currently there's only one reinsurer in the Philippines. And then specifically recognized as constituting the doing of an insurance business within the meaning of this code. Fourth, doing or proposing to do any business in substance equivalent to any of the foregoing in a manner designed to evade the provisions of this code. So in case, there are businesses that are saying, oh, no, we're not offering insurance, but essentially the product or service that they're providing is similar to the characteristics of an insurance, then it would be construed as if they are an insurance company. Okay, and as such, or that they are offering insurance products. So they would be covered by this code, and they could be punished if they don't have the necessary permits. Okay, so they would still be under the provision or jurisdiction of the IC, Insurance Commission, and of course the BSP, Bangko Sentral ng Pilipinas. In the application of the provisions of this code, the fact that no profit is derived from the making of insurance contracts, agreements, or transactions, or that no separate or direct consideration is received therefore, shall not be deemed conclusive to show that the making thereof does not constitute the doing or transacting of an insurance business. Okay, so this is in the case of offering of services similar to the nature of the insurance, but they're saying that even if that person asserts that there's no payment of premium, so how is it that we're an insurance business? Okay, but again, if the nature is essentially that of an insurance product or an insurance service, then the absence of premium payments would not conclude that it's not an insurance. Okay, as long as it has the elements of an insurance contract, then it would be deemed as a contract of insurance. As used in this code, the term commissioner means the insurance commissioner. And then we have chapter 1, contract of insurance. What may be insured? Okay, so any contingent or unknown event, whether past, future, which may by a person having an insurance insurable interest or fatal liability against him may be insured against, subject to the provisions of this chapter. Okay, and then we have additional clauses here. The consent of spouse is not necessary for the validity of the insurance policy taken out by a married person on his or her life or that of his children. So if you're a married person and then you have a spouse and then you want to take out an insurance for yourself or for her or for your children, then the consent of the other party is not needed. Okay, you can avail of an insurance contract or an insurance service on your own. Okay, you don't need anyone else's consent for that matter. All rights, title, and interest in the policy of insurance taken out by an original owner on the life or health of the person insured shall automatically vest in the latter upon the death of the original owner, unless otherwise provided for in the policy. So, of course, for example, didn't mean to say that. In case that, for example, I'm the original owner, I took a life insurance or a health insurance, and then or health of the person insured shall automatically vest in the latter, the insured, upon the death of the original owner. So, for example, I took out the health insurance for my parents, or and then if I die, then the benefit would vest to the benefit of the latter, the person insured. Okay. So, unless otherwise provided for in the policy, okay, depending on, of course, the provisions of the contract. Still, if there are provisions in the contract that would prevail over any other provision that may be found here, alright? Because essentially, this provides that whatever is provided in the policy, as long as it's not disadvantageous to any of the party, as long as it's not onerous, as long as it abides within the other laws in the land, then it would be what do you call this, enforceable, right? Okay, so let's go back to this one. Any contingent or unknown event, like death, accidents, possibility of fraud, cases of staffa, you transact with one person, and then this person did not comply with your contract, with your agreement, and then he ran away with the money or something, or he did not give to you, or let's say, the product or service that he promised to do after you paid him. So that's also a contingency. And then, for example, carriers, all right, shipping, transportation of goods. Okay, so you may insure the goods that will be transported. So in case the transport meets an accident, so there's indemnification. Okay, so there would be claims against that. Okay, or let's say there's calamity or something, there's fire. So let's say, or an accident, or the person ran away with the goods, or the goods were lost. Instead of sending it to this place, it was sent somewhere else, and then it's been used already there, and it hasn't reached the actual beneficiary, right? So those are different types of contingencies. And then, of course, you have health. The contingency is that you don't know when you're going to get sick, you don't know when you're going to develop any illnesses, things like that. And of course, unemployment as well, although of course we have this in SSS and GSIS. Not sure about insurance companies if they do provide this, probably not. Okay, but it's a type of insurance, okay, that if you lose your work, they're going to provide some sort of indemnification to pay you some sort of allowance as you transition from employment to unemployment to finding a new job again. Okay, but again, that part does not apply to insurance companies. That's mostly for SSS and GSIS. Okay, and then of course we have again the calamities, fire, typhoons, earthquakes, and damages. Okay, so essentially, if these things happen, then if there are damages, or if there are losses, or if there's a liability to make good on a promise or on a contract, then the insurance company would would pay the person that has been injured, or who suffered the losses, or who is supposedly to be paid for that particular loss or contingent event that happened, right? That damaged someone. Okay. Alright, and then we have section 4. The preceding section does not authorize an insurance for or against the drawing of any lottery, or for or against any chance or ticket in a lottery drawing a prize. Okay, so insurance does not include, the possibility of winning the lottery. Okay, so that's not it. Okay, all kinds of insurance are subject, although essentially that's a contingent. It's a contingent event, right? But it's not insurable. All kinds of insurance are subject to the provisions of this chapter so far as the provisions can apply. Title 2. Parties to the contract. So every corporation, partnership, association duly authorized to transact insurance business as elsewhere provided in this code may be an insurer. Okay, so insurance companies. Anyone except a public enemy may be insured. Okay, so if you're a public enemy, nope, you cannot avail of insurance services. unless the policy otherwise provides where a mortgagor of property effects insurance in his own name, providing that the loss shall be payable to the mortgagee, or assigns a policy of insurance to a mortgagee, the insurance is deemed to be upon the interest of the mortgagor, who does not cease to be a party to the original contract or any act of his prior to the loss, which would otherwise avoid the insurance, will have the same effect, although the property is in the hands of the mortgagee. But any act which, under the contract of insurance, is to be performed by the mortgagor may be performed by the mortgagee therein named with the same effect as it had been performed by the mortgagor. Alright, so this is essentially with regards to debt. If you notice, there are cooperatives or lending companies wherein when you borrow money from them, when you took out a loan, they do provide a certain insurance as well, that in case you meet an accident and you are unable to pay your debt, then the insurance company would pay the debt for you, all right, because you're unable. Okay, it is for the benefit of the lender, right? So in the case of mortgage or mortgagee of a property, of course, if the person is unable to pay the amortization for that mortgage property, although the mortgage property is of course in the hands of the one being paid, and then in the case that the person is unable to pay or defaulted in payment, then the insurance company would on his behalf pay the person that needs to be paid. Okay, so something like that. Alright. Section 9. If an insurer assents to the transfer of an insurance from a mortgagor to a mortgagee, and at that time of his assent imposes further obligations on the assignee, making a new contract with him, the acts of the mortgagor cannot affect the rights of the said assignee. Okay, so in effect, although, for example, in that case, although the money went to the one that needs to be paid, in effect, they both benefited. The mortgagee. The mortgagor also benefited because he's unable to pay, and yet the insurance company paid the debt for him. And then this person, he is not receiving any money from the mortgagor, but since the insurance covered that, so he was paid, so he received money. Essentially, they both benefited, right? And then in case there is, a transfer of insurance from mortgagor to mortgagee, okay, from the person who needs to pay to the person who needs to be paid. So essentially, it's the same, all right? Both of them would benefit in a way. Okay, Title 3, Insurable Interest. Every person has an insurable interest in the life and health of himself, or of his spouse, and of his children. So in a way, you can take out an insurance for yourself, for your life and for your health, or for your spouse, or for your children. Sometimes you can also get them for your, parents. Of any person on whom he depends wholly or in part for education or support, or in whom he has a pecuniary interest. Okay, so that's why you can also do it for your parents. Of any person under a legal obligation to him for the payment of money, or respecting property or services, of which death or illness might delay or prevent the performance, and of any person upon whose life any estate or interest vested in him depends. Okay. 11. The insured shall have the right to change the beneficiary he designated in the policy unless he has expressly waived this right in said policy. Okay. So if you take out a loan, you have to designate a beneficiary. Okay, but if you designate the beneficiary as irrevocable, and then you suddenly change your mind later on, you want to change the beneficiary, then you would have to get the consent of your original beneficiary as well, because you essentially put irrevocable, which means you cannot change it. So if you want to change it, you have to get his permission as well. All right. So things like that. Notwithstanding the foregoing, in the event the insured does not change the beneficiary during his lifetime, the designation shall be deemed irrevocable. All right. So that's it. So in a way, it's better if when you start to designate someone, you can start with designation as revocable. Okay, so in case you change your mind later on, you realize that this person would, not use the money for good. So you want to change the beneficiary to someone else who's going to manage the money properly, the proceeds, and use well. So you might, designate the first beneficiary on as revocable, so that you can change it later on. Section 12, the interest of a beneficiary in a life insurance policy shall be forfeited when the beneficiary is the principal, accomplice, or accessory in willfully bringing about the death of the insured. So this has gotten dark real quick. In such a case, the share forfeited shall pass on to the other beneficiaries unless otherwise disqualified. So, in recent months, I've been watching that chapter. So it's a YouTube channel of true crime documentaries. And there are a lot of cases wherein someone killed someone, family member or spouse, so that they could receive the proceeds of the life insurance with that person. Okay, so of course, they have a rule on insurance policies that if you cause the death of someone, okay, you're not even if you're the named beneficiary, you're not going to receive it, right? Because you're evil. Okay, and then of course the proceeds will then go to the next. We have legal, what do you call this? We have the law on succession or law on inheritance. So in that case, even if there's someone named as beneficiary, if he's disqualified because of certain acts, then the law provides who will be the next heir or the next person who would be recipient of the estate or whatever's been left behind by the person who died, right? So essentially, if you're a married person, it would be your I think children, and then if you don't have children, it will be your spouse. If you don't have children and spouse, it will be your parents, I think. And then if you don't have parents, then it would be your siblings. If you don't have all those, then it would be your, I think, next of kin, whoever is your next of kin, right? The interest of a beneficiary, sorry, we've already read that. Section 13, every interest in property, whether real or personal, or any relation thereto, or liability in respect thereof, of such nature that the contemplated burial might directly dignify the insured is an insurable interest. Okay, an insurable interest in property may consist in an existing interest of property. So it's the type of insurance could be, accident. So if an accident occurs and the property is damaged, like in vehicles, or even in houses, roadside houses, or earthquake could happen, so the property could be damaged, right? And then you have your an existing interest, and inchoate interest founded on an existing interest or an expectancy coupled with an existing interest in that out of which the expectancy arises. All right. So normally, you have that accident, calamity, fire. Okay. A carrier of depositor or depository of any kind has an insurable interest in a thing held by him as such to the extent of his liability but not to exceed the value thereof. So shipping, right? So sometimes they do provide, an insurance, and then they want you to declare the value of the item that you want to transport with their company, so that in case it gets lost, then they just pay you with insurance, right? And then they would know how much to pay you because that's the value that you declared. It's based on the value that you declared is the amount of the item that you want them to transport, right? A mere contingent or expectant interest in anything not founded on an actual right to the thing, nor upon any valid contract for it, is not insurable. Okay, so if you don't have, an interest, mere contingent, or it's only an expectant interest, but it's not an actual right, then that's not insurable. All right. The measure of an insurable interest in property is the extent to which the insured might be damnified by loss or injury thereof. So essentially, the beneficiary is someone that would suffer a loss or might be damnified by the loss, or someone who would be held responsible to pay for damages or for the loss. Okay, so that's an insurable interest in property. Okay. No contract or policy of insurance in property shall be enforceable except for the benefit of some person having an insurable interest in the property insured. Okay, so you cannot put an insurance on someone else's property if you don't have an interest on it. Okay, interest as in, you will suffer a loss if something happens to it. All right, so if you want to insure your neighbor's house, if you have no interest in it, like you did not buy it, you're not going to buy it in the future, you don't have a contract with them that you're going to acquire it in the future, then there's no interest. That's not insurable interest, right? Okay, no contract or policy of insurance, okay, so shall be enforceable except for the benefits. Okay. An interest in property insured must exist when the insurance takes effect and when the loss occurs, but need not exist in the meantime. The interest in the life or health of a person insured must exist when the insurance takes effect, but need not exist thereafter or when the loss occurs. Okay. So normally life insurance, when someone dies, the beneficiaries designated by the person who died, who took insurance on himself. Section 20, except in cases specified in the next 4 sections, in the cases of life, accident, health insurance, a change of interest in any part of a thing insured, unaccompanied by a corresponding change of interest in the insurance, suspends the insurance to an equivalent extent until the interest in the thing and the interest in the insurance are vested in the same person. Okay. Change of interest after occurrence of an injury which results in a loss does not affect the right of the insured to indemnify for the loss. Change of interest in one or more of several distinct things separately insured by one policy does not void the insurance as to the others. Okay. A change of interest by will or succession or on the death of the insured does not avoid an insurance, and his interest in the insurance passes to the person taking his interest in the thing insured. So basically his estate. A transfer of interest by one of several partners, joint owners, or owners in common who are jointly insured to the others does not avoid an insurance even though it has been agreed that the insurance shall cease upon an alienation of the thing insured. So if it's a group insurance, someone left, so those who remain, they would still be insured. All right. Average stipulation in the policy of insurance for the payment of loss, whether the person insured has or has not any interest in the property insured, or that the policy shall be received as proof of such interest, and every policy executed by way of gaming or wagering is void. It's essentially gaming, gambling, lottery. Those cannot be subject to insurance. Okay, you cannot insure someone's winning. Okay, in those probability games of probability. Okay, next, Title 4 is about concealment. So there are types of insurances wherein they needed information and they need you to be honest or truthful so that they could assess the level of risk and how much premium they would need to charge you with, alright? Or sometimes it would also affect their decision on whether to approve or reject your application for an insurance, especially in health insurances. So sometimes you have to declare, for example, genetics or family history of certain diseases. So if you have a family history of a certain disease, you have to declare that so that they could assess if they would accept you or reject you, or if they would require you to undergo certain medical tests just to check if you're a carrier of this disease or not. And then if there's a possibility that you are, then they could charge a higher premium, or if it's already there, then they would not accept your application. So if there is concealment, it's possible that that the contract could be void and the insurance company could deny the claim because you did not declare everything properly. You concealed a very vital information that would affect their decision when you took the contract, the insurance contract with them. Alright, so it's very important that if the insurance company requires you to provide information, you have to be truthful on it. And what do you call this? Intentional concealment or assumption of if you simply assume that they already knew, if they have no possible way of knowing, then it would be your fault. Okay, you should have declared it. You should have told them, right? So there's level of materiality, right to information, nature of information, amount of interest. Excuse me. Okay, and then Title 5, we have representation. So it may be oral or written, but normally it should be written, right? So that it can prove that the contract exists, right? A representation may be made at the time of or before insurance of the policy. So sometimes, when you're at the bank and you get to talk with the bank insurance representatives, and then you just say that, oh, yes, I'm interested, maybe later I would get an insurance, right? So that's just an oral expression of interest, but it's not necessarily, that's not necessarily a policy already for an insurance or an approved contract of insurance, right? The language of a representation is to be interpreted by the same rules as the language of contracts in general, so normally in English. Representation as to the future is to be deemed a promise unless it appears that it was merely a statement of belief or expectation. So normally, when you go to the bank and you decide that you want to get an insurance, so you do an assessment with the bank insurance representative, and then there's assessment, you answer certain questions, and then you provide your first premium payment, and then after that, if it's an approved insurance, then they would send you the final insurance contract or policy, right? And then that would be your proof that you are in fact insured and you have that contract with the insurance company. It may be altered or withdrawn before the issuance is effected, but not afterwards. I think they have 30 days. So if you change your mind before 30 days is up, then you can do so. You can just go to them and say, no, I don't think I'm going to continue with this. So you can get a refund of your money. Again, that's within 30 days, right? If it's after the 30 days, I don't think they're obligated to refund you your premium payment, and then you just, do not continue with it, and they're not going to issue you with the policy contract or the policy statement, right? A representation must be presumed to refer to the date on which the contract goes into effect, alright? Whatever date is written on the contract. When a person insured has no personal knowledge of a fact, he may nevertheless repeat information which he has upon the subject, and which he believes to be true with the explanation that he does so on the information of others, or he may submit the information in its whole extent to the insurer, and in either case is irresponsible for its truth unless it proceeds from an agent of the insured whose duty is to give the information. Okay. So for example, you have children, you took out, what do you call this? You took out insurance for your children, and then you did not know that your children has, certain conditions. You are not aware, but you're the one who took the insurance for them, right? Okay, and then it's not exactly intentional concealment because you do not know, because you're insuring someone else, not your own person. So there are cases like that. Representation is to be deemed false when the facts fail to correspond with its assertion or stipulations. If a representation is false in a material point, so very significant and which could affect the decision of the insurance company, whether affirmative or promissory, the injured party is entitled to rescind the contract from the time when the representation becomes false. Okay, so the contract would essentially be void or not in effect. The materiality of representation is determined by the same rules as the materiality of concealment. Provisions of this chapter shall apply as well to modification of a contract of insurance to its original formation. Okay, so if there are certain changes that you want to take, that you want to happen for your insurance policy, let's say certain changes, then you can actually apply. Just talk to your bank assurance and then fill out some forms and then submit the documentary requirements. Then it would be modified according to your wishes, right? Whenever a right to rescind the contract of insurance is given to the insurer by any provision of this chapter, such right must be exercised previous to the commencement of an action on the contract, right? After a policy of life insurance made payable on the death of the insured shall have been enforced during the lifetime of the insured for a period of 2 years from the date of its issue or of its last reinstatement, the insurer cannot prove that the policy is void ab initio, or from the beginning, or is rescindable by reason of the fraudulent concealment or misrepresentation of the insured or his agent. Alright. Title 6, the policy. So the written instrument is set forth in a policy of insurance. Okay? It's called a policy of insurance. The policy shall be in printed form, which may contain blank spaces and any word, phrase, clause, mark, sign, symbol, signature, number, word necessary to complete the contract of insurance shall be written on the blank spaces provided therein. Okay. Any rider, clause, warranty, or endorsement purporting to be part of the contract of insurance and which is pasted or attached to said policy and is not binding on the insured unless the descriptive title or name of the rider, clause, warranty, or endorsement is also mentioned and written on the blank spaces provided in the policy. So a policy is normally like a booklet or some sort of handbook, and then everything's there. If there are any riders or clause, warranties, or endorsements, so that should also be included in that particular document. Okay. Unless applied for by the insured or owner, any rider, clause, warranty, or endorsement issued after the original policy shall be countersigned by the insured or owner, which counter signature shall be taken as his agreement to the contents of such rider, clause, warranty, or endorsement. So let's say after the initial issuance of the policy, right? And then the owner's like, I think I'd like to get as well some riders, clauses, warranty, or endorsements. So in that case, so it's a separate document. It would not be included in the original policy, but it would be binding as long as they are signed by both parties, right? The insurance company, representative, and then the person taking out the insurance. Notwithstanding the foregoing, the policy may be in electronic form, PDF copies, Word documents, subject to the pertinent provisions of RA 8792, otherwise known as the Electronic Commerce Act, and to such rules and regulations as may be prescribed by the Commissioner. Policy insurance must specify the parties between whom the contract is made, so normally name of the person and then name of the company and then their representative. The amount to be insured except in the cases of open or running policies. So normally there is amounts there, in case of the contingent event happens. So there's already amounts provided there. How much could be claimed by the beneficiaries. The premium, or if the insurance is of a character where the exact premium is only determinable upon the termination of the contract, a statement on the basis and rates upon which the final premium is to be determined. So it should be stated there as well how much premium would be paid by the person. Property or life insured, interest of the insured in property insured if he is not the absolute owner thereof. Risk insured against the period during which the insurance is to continue. Section 52, cover notes may be issued to bind insurance temporarily pending the issuance of policy. Within 60 days after issue of a cover note, normally after you provide your first payment, so you don't have the policy yet, but they do give the cover note, some sort of evidence that you did pay the first payment and that you're just waiting for the issuance of the policy. So that would be issued within 60 days, right? Cover notes. Okay, so that's essentially it. The insurance proceeds shall be applied exclusively to the proper interest of the person is whose name or for whose benefit unless otherwise specified in the policy. So the name of the beneficiary is also included in the policy. When an insurance contract is executed with an agent or trustee as the insured, the fact that his principal or beneficiary is the real party in interest may be indicated by describing the insured as agent or trustee. Alright, so you can do that. To render an insurance effected by one partner or part owner applicable to the interests of his co-partners or other part owners. So in case, businesses, they would insure the building or property. So it's somehow a group, okay, part owner, something like that. When the description of the insured in a policy is so general that it may comprehend any person or any class of persons, only he who can show that it was intended to include him can claim the benefit of the policy. So it should be, very clear on who the beneficiaries are. So if it's just a description of the beneficiary, so it's subject to interpretation, and it needs to be proven who the beneficiary is, or if someone is included in being able to claim the benefit of the policy. A policy may be so framed that it will inure to the benefit of whomsoever during the continuance of the risk may become the owner of the interest insured. The mere transfer of a thing insured does not transfer the policy, but suspends it until the same person becomes the owner of both the policy and the thing insured. So example, for car, it's insured and then you sold it to someone else, and then there's policy on it, or it's already insured. So there's transfer of ownership, so the insurance would inure to the benefit of the new owner, possibly, if but essentially you still need to inform the insurance company of such transfer or change in ownership of an insured property. Okay. Policy is either open, valued, or running. Open policy. The value of the thing insured is not agreed upon, and the amount represents the insurer's maximum liability. The value of such thing insured shall be ascertained at the time of the loss. Valued policy, so on its face an agreement that the thing insured shall be valued at a specified sum. So there's already an exact amount of how much would be given out if the contingent event happens. Alright. In the open policy, maybe some just sort of computation or factors to be taken into consideration to compute for the value of the proceeds or the benefits. A running policy is one which contemplates successive insurances and which provides that the object of the policy may be from time to time defined, especially as to the subjects of insurance by additional statements or endorsements. Okay, conditions. Limiting the time for commencing an action or under the period of less than 1 year is void. No policy other than life shall be cancelled by the insurer except upon... No policy of insurance other than life shall be cancelled by the insurer except upon prior notice thereof to the insured, and no notice of cancellation shall be effective unless it is based on the occurrence after the effective date of the policy of one or more of the following. It's a bit confusing for me because of this one. Other than life. Okay, non-payment of premium, conviction of a crime arising out of acts increasing the hazard insured against. Okay, so for example, this is essentially a fraud, increasing the hazard insured against. Discovery of fraud or material misrepresentation, discovery of willful or reckless acts or omissions, you're trying to get into an accident on your own. Okay, physical changes in the property insured which result in the property becoming uninsurable. Alright. A discovery of other insurance coverage that makes the total insurance in excess of the value of the property insured. Okay. So sometimes there are certain policies that prohibit you from taking another insurance on the same property, right? They call it double insurance. It's not exactly illegal, but there are prohibitions or restrictions on it, right? Let's see here. Letter E, physical changes. So normally in cars, okay, it should be in its original form or in its manufactured form. If you made changes on it, you made it faster, you changed the parts, which in a way would be, susceptible to more risk. So in that case, it would be an insurable. All right. A determination by the commissioner that the continuation of the policy would violate or replace the insurer in violation of this code. Okay, so there's that. All notices of cancellation mentioned in the preceding section shall be in writing, mailed, or delivered to the named insured at the address shown in the policy or to his broker, provided the broker is authorized in writing by the policy owner to receive the notice of cancellation on his behalf, and shall state which of the grounds set forth in section 64 is relied upon, that upon written request of the named insured, the insurer will furnish the facts on which the cancellation is based. Okay. In case of insurance other than life, unless the insurer at least 45 days in advance mails or delivers to the named insured. What's this? The named insurer shall be entitled to renew the policy upon payment of the premium due to the effective date of the renewal. Any policy written for a term of less than 1 year shall be considered as if written for a term of 1 year. Any policy written for a term longer than 1 year with no fixed expiration shall be considered as if written successive policy periods or terms of 1 year. Alright. Title 7, warranty. So it's either express or implied. Warranty may relate to the past, present, future, or to any or all of these. Okay, no particular form of words is necessary to create a warranty. So for example, warranty on a vehicle. So essentially, it's like a guarantee that you're saying it's in good condition, it doesn't have any problems, and then sometime later on, if it gets into an accident because of, let's say, defective brakes or defective engine or something, then there is warranty, so that would be taken into account, right? So again, that's just an example on other, on other types of insurance. So there are other examples, right? Title number 8, this is about premium. So an insurer is entitled to the payment of the premium. The insurance company would receive the payment, right, of the premium from the person. And this is, for the benefit of the thing insured, exposed to peril, insured against, right? Notwithstanding any agreement to the contrary, no policy or contract of insurance issued by an insurance company is valid and binding unless and until the premium thereof has been paid, except in the case of a life or an industrial life policy, whenever the grace period provision applies, or whenever under the broker and agency agreements with duly licensed intermediaries, a 90-day credit extension is given. No credit extension to a duly licensed intermediary should exceed 90 days from the date of issuance of the policy. Okay, employees of the government agency, so they could opt for salary deduction for the payment of the premiums. Okay, acknowledgement or receipt, official receipt, so there should be evidence of the payment or receipt. Okay, a person insured is entitled to a return of premium as follows. Okay, if the insured thing is no longer exposed to any perils or things like that, the insurance is made for a definite period of time and the insured surrenders his policy. Okay, something like, oh, I don't want to continue. Okay, don't want to continue paying, I don't want the insurance anymore. So, okay, if a peril insured against has existed and the insurer has been liable for any period, however short, the insured is not entitled to return of premium so far as particular risk is concerned. Okay, and then there are other reasons here. Title 9, loss. Okay, so if the contingency happens and there is essentially a loss, so they would that would cause the insurance company to be liable or responsible for the payment of the claims or the benefits to the beneficiary, right? Okay, so there are what they call this statement here. The insurer or the insurance company would not be liable if it is, caused by willful act or through the connivance of the insured, okay, or through evil acts by the insured and the person involved in the contract, right? Notice of loss. Okay. In case of loss of an insurance against fire, an insurer is exonerated if written notice thereof be not be given to him by an insured or some person entitled to the benefit of the insured. Okay, so this is why I'm saying if you are insured and you have a beneficiary, it's important that you tell them that you are insured so that in case something happens, they would be able to file a claim against your insurance, right? Because if you don't tell them, they won't know. Because there is a need for them to notify the insurance company. If the insurance company is not notified, then they are not obligated to pay out the claims, right? It's probably because they have a lot of a lot of clients, so they wouldn't have the time to check up on each client to check, hey, are you still alive, or hey, are you sick, or hey, do you need to claim against the policy or things like that. Okay, so there's a need for the beneficiary to notify the insurance company. Okay, if there's no notification, then the insurer or the insurance company is not going to be held liable, right? Things like that. There are others here. Can read on your own sweet time, please. Okay, so here we have the double insurance. So same person insured by several insurers separately in respect to the same subject and interest. Okay, where the insured in a policy other than life is overinsured by double insurance. So, for example, you have your car is insured and then it gets into an accident. So you have two companies, for example. So one company already paid for it, for the damages, for the repair, things like that. And then are you also going to claim for the same benefits, for the same payouts from the second company? So sometimes that's not going to be allowed. Sometimes if the coverage of the first company is not enough to to return the property to its original state or functioning state, then you can file an additional claim onto the second insurance. But if it's not and the first company already covered all that you needed to spend to basically repair the property, then that's already good enough. You probably would not be able to claim against the second company, alright? Except for life. Life insurance is a different matter, normally. Okay. So there are other provisions here. Reinsurance. A contract of reinsurance is one by which an insurer procures a third person to insure him against loss or liability by reason of such original insurance. So here we have only one reinsurer. I forgot the name. What's the name again? Philippine Reinsurer Corporation or something, right? Let's check with this. Where is it again? We've mentioned it in the previous video. Oh, here. National Reinsurance Corporation of the Philippines, the sole reinsurer. So all of the insurance companies, their reinsurer is the National Reinsurance Corporation of the Philippines. Okay, so essentially they transfer the risk to this other company, right? Reinsurance is presumed to be a contract of indemnity against liability and not merely against damage. The original insured has no interest in a contract of reinsurance. So, contract of insurance between a person or business or group, and then you have your insurance company. So that's the contract between them. And then this insurance company, you have the reinsurer. They have a contract between them. So the reinsurer has nothing to do with the original insured person, right? So their reinsurance is between the insurance company and the reinsurer, all right? Okay, so that's it for this video. So there's a lot, right? So general provisions of the insurance code, and then later on I'm going to create another video for the classes of insurance. All right, so that's it for this one. Thanks and bye. If you have other questions, maybe just in the comments. Alright. Pause. PS. Postscript. Alright. Again, thanks and bye.